Today, we're going to dive into an example case study where we'll cover the 6-step checklist that you need to retire at the age of 67 with a $375,000 portfolio. So let's dive right into it. Here we have James and Lindy. James and Lindy today are 63 years old. James and Lindy are working. James has a salary of $65,000 and Lindy has a salary of $50,000. For their retirement, for their Social Security benefit in retirement, we are going to use the estimate here in the software. The way this works is we will use the current salary and salary increases to estimate the future Social Security benefit at full retirement age for both James and Lindy. It's important to note that we are assuming a 3% increase in their salary per year up until retirement. So this is factored in to that benefit. Going into their savings, James and Lindy both have a 401k and they're putting away 3% of their salary into their 401k. This is because they're matched at 3%. In addition to the 401k, they have a joint taxable account that they're putting $3,000 per year away. Now going into their expenses, pre-retirement, they're spending $5,000 per month. The first line item on that 6-step checklist is identify and define your short and long-term retirement goals. This is where your plan starts. What do you want to do in retirement? And for James and Lindy, for them, they would like to retire at the age of 67. They would like to spend $4,500 per month in retirement. On top of that, they would like to go on an annual vacation. They would like to budget $2,400 per year for just other things that might come up. And then we also have the annual retirement health cost here. So as we mentioned, they would like to go on a trip every year. We're assuming this starts in retirement for the amount of $4,000 every year up until the age of 80. We're assuming that they spend $2,400 starting at retirement every year up until the age of 80. In addition to these goals here that we've defined, James and Lindy, if it makes sense, can add other goals into their plan. Do they have a long-term care strategy? What does that look like? Obviously, very important to consider in your retirement plan. Will they be funding education for a kid, dependent, or family member? Would they like to buy a new car? Do they need a plan to pay for a wedding? Do they want to buy a new piece of property, whether that's relocating, a second home, an investment property? Do they want to buy other assets, whether that's a business purchase or other lifestyle asset purchase? Will they give in retirement, whether this is through the form of personal gifts or charitable giving? What are their legacy plans? Do they have any legacy plans or goals? And then other goals that you may have in retirement. So we can see here that these goals are dynamic, custom to you and unique to your situation. So now let's dive into the net worth of James and Lindy. They have a $693,000 net worth as of today. $18,000 in the bank, $375,000 in their investments. James's 401k has $200,000 in it. Lindy's 401k has $150,000 in it. In that joint taxable account, that has $25,000 in it. Their primary home, which they own, they do not have a loan on that, is worth $300,000. So let's go into the retirement analysis. This is where line item number 2 comes in. Can you afford your desired lifestyle? And looking at the probability of success for James and Lindy, they have a 91% probability of success with $1.4 million in median ending assets at the end of their plan. Again, for them, the end of the plan is at the age of 90. So for James and Lindy, as of today, based on our inputs, our income, expenses, goals, etc., they can afford this desired lifestyle. Now, is this the lifestyle that they actually want to live? Are there other things that they would like to do? Whether it's travel more, maybe it is relocate, maybe it's spend more time with the grandkids. What are those goals and what are those costs? Maybe it's retiring earlier. Could they swing this? So we really want to be intentional because depending on the inputs that we have here, depending on what your retirement goals are, we need to make sure and identify that we can afford that lifestyle. So before we make any changes to the existing plan, let's go into line item number 3 on our checklist. Identify our income and our income gaps if there are any. So as we mentioned here, in retirement, James and Lindy would like to spend $4,500 per month. Our Social Security will also kick in at full retirement age, which is the age of 67, and that is the same age at which they'll both retire. Therefore, we won't have a gap in income, meaning we aren't retiring early based on these preset assumptions here. So as soon as we retire, as soon as we lose our salary, Social Security will kick in. Now let's go into our cash flows to get a better idea of our income inflows and our outflows throughout our entire plan here. As we can see, up until retirement, we have positive net flows and spend from unsaved cash flows here in excess of $20,000 per year. This just means that we have an additional $20,000. When we take our income inflows and subtract our total outflows, we have $20,000+ left. So this means that we could plan maybe more strategically. Should we invest this? Should we put this into our taxable account? Should we take trips for the next couple years? This is an extra $20,000 that we should strategically plan to use. Now at the age of 67, when we retire and Social Security kicks in, you can see that we have a negative net flow. That is, we have $56,000 in 2029 when we're 67 coming in from Social Security, but we have expenses in the amount of $87,000+ per year. And therefore, we have a negative net flow of $30,000+. So this needs to come from our portfolio. We're going to be reliant on our portfolio to fill that income gap from the age of 67 in 2029 all the way until 2038 at the age of 76. And then we can see between Social Security and our planned distributions, those are distributions that we take from that tax deferred account. Starting in 2039, we actually have spend from unsaved cash flows again. And this carries us through the end of our plan. So looking at this plan here, we can see that, for James and Lindy, for the next couple years while they're working, we're going to have some spend from unsaved cash flows. We're then going to hit a period in retirement where we need to be reliant on our portfolio for income to fill the gap between our Social Security benefit and our expenses there. And we can see that amount obviously varies, but it's anywhere from $2,000 to $3,000 per month that we're going to be reliant on our portfolio. This brings us in to line item 4 and 5. I like to look at these two things together. That is our withdrawal strategy as well as our investment strategy. Where are we taking this money from, and how are we invested in such a way where we consider these withdrawals? So first, let's just look at our withdrawal strategy today. Going back to our retirement analysis, we can go over here to our retirement details and look at the withdrawal rate of the plan. And as we can see here, for the lion's share of retirement, we have a sub 6% withdrawal rate. Later on in retirement, we get a little bit more reliant on our portfolio. But overall, this withdrawal rate looks pretty healthy for the lion's share of retirement. And so now we need to look at our investments. How are we invested to support this sort of withdrawal rate from our portfolio? Going into our investments, we can see that today across all of our accounts, across the 2 401k accounts and our taxable account, we have about an 80-20 portfolio. 80% equity, 79%, and 21% fixed income. We're assuming a hypothetical annual return of 9.5%. Now, looking at how we withdraw income from our portfolio, we know that we're going to have to bucket our investments. And what I mean by that is bucket our investments based on the timeline in which we need that money, those assets. Bucket number 1. Bucket number 1 is seen as our liquidity bucket. These are funds that we're going to need in the next 0 to 3 years. We need to set aside this money so that it's not as subject to market volatility and cyclical market movements. The last thing we want is an adverse market that impacts the money that we need over the next couple years. Bucket number two. Bucket number two is our defensive bucket. This is money that we might need in the next 4 to 10 years. This money is largely invested in bonds and dividend-paying stocks. And finally, bucket number three. Bucket number three is our growth bucket. We don't need this money for 10 plus years. And therefore, we're largely invested in growthier investments. Think stocks. So looking at our allocation here, we can see that most likely across all of our accounts especially, we probably won't have that 80-20 portfolio. Looking at our joint investment account, we're invested 70% equity, 30% fixed income. Now, if we think about our withdrawal strategy, again, looking at line item number 4 and 5, our investment and withdrawal strategy, when we think about our withdrawal strategy, the way that we're going to withdraw assets from our various accounts is by using the traditional withdrawal order. That is, first pull money from our taxable account, then our tax-deferred accounts, and if applicable, from our tax-free Roth accounts. So looking at our taxable brokerage account here, we know that we're going to be reliant on this portfolio first to fill that income gap. And therefore, odds are we aren't going to have a 70-30 portfolio. Because if we recall, we want 0 to 3 years in our liquidity bucket. If our taxable brokerage account is our liquidity bucket, then we know that we need to up the cash allocation for this bucket. So let's just assume that for this joint investment account, we move from a 70-30 portfolio, again, this is just hypothetical, to a 20-80 portfolio, 20% equity, 80% fixed income, with a hypothetical annual rate of return of 4.9%. Now, it's important to note that we discovered that we're going to be relying on our portfolio anywhere from 4 to 6% per year in the form of a withdrawal rate to fund that income gap. So we want to be mindful of that relative to our annual return here. In our taxable brokerage account, maybe we do have a 4.9% hypothetical annual rate of return. But if we recall, we have those other two buckets. That is our defensive bucket and our growth bucket. And so overall, our portfolio should be invested in such a way where we consider, yes, the investment strategy. How are we invested across bucket number 1, 2, and 3? But also keeping in mind our withdrawal strategy. How much money are we pulling out? When are we pulling it out? And from what accounts are we pulling this money from? So obviously this is just an overview of what we do, but making sure that your investment strategy is aligned with how you're using those assets is crucial for your plan. Now this brings us in to the last line item here. Line item number 6, your tax plan for retirement. When we think about taxes, there's a variety of things to think about. But for the sake of this example, let's go through Roth conversions. Do Roth conversions make sense for James and Lindy? In addition to Roth conversions, especially in your taxable brokerage account, one thing you should be thinking about is tax loss and tax gain harvesting. Relative to your tax-deferred accounts, do qualified charitable distributions or other forms of charitable giving make sense for you? So just a couple things to be mindful of. Again, for the sake of this example, let's see how Roth conversions play out for James and Lindy. Going into here, we can see that these are our ordinary income tax brackets. The light blue bracket here is the 10% bracket, and the green bracket here is the 12% bracket. So what we're going to do is we're going to scroll down and again use the withdrawal sequence of taxable, tax-deferred, and tax-free. We just talked about that relative to our traditional withdrawal order. And we're going to see what it looks like if we go from filling up no tax bracket to filling up the 10% tax bracket. That is doing Roth conversions up to the 10% tax bracket. And as we can see here, this will result in $419,000 more in tax-adjusted ending assets for both James and Lindy. So yeah, Roth conversions for them up to that 10% tax bracket could make sense. Now what happens if we increase that to the 12% tax bracket? Well, as we can see here, this is actually even more. up to $424,000 more in tax-adjusted ending assets. Now, what happens if we up that to the 22% tax bracket? $709,000 more in tax-adjusted ending assets. So for James and Lindy, doing Roth conversions up to the 22% tax bracket early on in their plan could result in $709,000 more in tax-adjusted ending assets. Now, looking at this, you might say, well, great. But the thing is, we can't just do Roth conversions because we see this number. We need to be strategic about this. And so let's dive into when these Roth conversions for James and Lindy make sense. And going into the details tab here, we can see that these conversions make most sense early on in our plan, actually starting today. We see here that in 2025, converting $126,000 makes sense for them, then $128,000, and so on and so forth. Now, again, this doesn't mean that everyone should do Roth conversions. And in fact, for many people, they don't make sense. But for this situation, it could, for James and Lindy, result in $709,000 more in tax-adjusted ending assets. And so this is the 6-step process checklist that we take our clients through to see what their plan looks like. And not just their plan, but to clearly identify, what are your goals in retirement? Can you afford the lifestyle that you want to live in retirement? Identify your income. Where is it coming from? And if there is a gap, how are we filling that gap? And then go into our investment and withdrawal strategy. How are we invested and where is our money coming from? And finally, what does our tax plan look like? How can we keep more of your hard-earned dollars in your pocket over the life of your plan? Guys, planning for retirement is crucial, and this is just the start. If you want to create a plan just like this, then I invite you to click the Create Your Free Plan in the description, and we'll see you there. Thank you so much. Bye-bye.